Hello, everybody. Thank you so much for joining us. Let's get started. Katerina, do you want to kick us off?
Of course. Hello, everyone. Thank you very much for joining us. So today is a very exciting day for us. We wanted to share with you some practical examples on how you can initiate your journey as it comes to OSFI's B-15 guidelines. As all of you will know, last week OSFI released an updated version of the B-15 guidelines, which makes our webinar today very timely. Today with you have, myself. My name is Katerina Kindyni, and I lead for EY Canada, our sustainability practice for financial institutions. We also have Aly from the team, who's a senior manager in our practice and has lots of experience working with Canadian financial institutions. And then Erin from Carbonhound. We are very proud of our strategic, partnership between EY and Carbonhound, with the goal to, make your journey when it comes to B-15 as easy, as possible. So today, what you will be able to see on the screen is the thought leadership that our teams have put together that explains what OSFI is expecting financial institutions to disclose. For large financial institutions, of course, they will go first this year, and then smaller financial institutions, that they have 1 year to, prepare for it. We'll make sure that after this session, all of you will get access both to the recording as well as the thought leadership. Without any further ado, I think we can start. Aly, do you want to kick us off?
Thank you, everyone, for joining. It's a pleasure to be here. As Katrina mentioned, we hope to share with you some real life examples from our work supporting our clients as they embark on their ESG transformation journey and navigating this dynamic landscape, one that has an element of uncertainty, but also provides a window of opportunity to really bring forward lots of innovative products to help your clients in their decarbonization and transmission pathways, and also evolve their business model to keep up with the new regulatory expectations and whatnot. As mandated, as I'm sure you've seen through the OSFI B-15, it focuses on four primary pillars: governance, strategy, risk management, and
Oh, I think we might have lost Aly there.
hello, can you
There
guys
we go. Now we're back.
So starting off with governance, Erin and I will be walking you through some real life examples. Maybe we'll kick it off with the first one. Um, what does governance entail when we think about climate risk? Really, target operating model. How do you ensure that there is a adequate governance and implementation throughout the three lines of defense, starting from your underwriting practices to your risk management department, which is the second line, as well as the third line, which is the internal audit. Usually, for our clients, be it typical deposit taking institutions, insurance companies, asset managers, or even sovereign entities here in Canada, we like to start it off the exercise with a what we call a current state assessment. For you to define your target state, you need to be very well equipped in the sense that understand where do you currently sit with respect to your peers, be it here in Canada or also on a global scale. Not only in terms of the nature of your portfolio, but also similarly sized institutions. And we do this, what we call a benchmarking or a peer assessment exercise across all the pillars, as you can see on the screen, that are mandated by OSFI, be it governance, strategy, risk management, metrics and targets, as well as disclosure. Upon going through that exercise, which is the initial phase, we then work with all the relevant stakeholders across the enterprise to really define that target state. The target state then helps them. Using that target state, we then formulate it into a roadmap, one that is both on the short term as well as the long term, and help define them. Do they want to meet minimum compliance, or do they want to really go above and beyond the curve in terms of innovative ways to address this uncertainty that comes with ESG and climate risk, and specifically? A target operating model is really meant as a facilitator to help you get to that target state. It defines the capabilities, the processes across the organization, but also how do you engage with your stakeholder. As I'm sure you're all aware, climate risk comes with increased reputation and um, regulatory risk because of the shareholder expectations and the group activism and advocacy groups as well out there. But it also comes with room to provide innovative financing products, as we will tackle, and we'll give you some real life examples in when we tackle the strategy element of OSFI B-15. So the first element of the target operating model, as I mentioned, is the capabilities and processes. The second element are what we call enablers. And that's where Erin and team are really our subject matter experts in terms of the technologies that are needed to enable all of that. Underpinning all of this, you need the right set of data, you need the right IT infrastructure, but you also need a capacity building and knowledge transfer component through the people and the hiring processes as well.
Yeah,
And
absolutely.
with that in mind, I'll hand it over to you, Erin, to share some of your thoughts on this one. Yeah.
Yeah, for sure. I think you covered a lot of the main points of getting to disclosure, which is really where EY comes in, and our partnership is, obviously in the technology side, we can help alleviate the burden of actually getting that reporting together for, effective oversight, whether that's board oversight or management oversight. And so one example that I wanted to highlight to share how folks that we've worked with have used technology to increase the effectiveness of their governance structures in their organization is actually not with a financial institution, but I think there's an interesting example of B Corp customers that have been doing this for a long time across industries. And usually some of the barriers that folks come up against is obviously data availability, right? So knowing, okay, if we're going to give a report to our board, how much can our board even trust that information to make strategic decisions? But as well, understanding the context behind the numbers, what models did we use, and having the level of granularity where people can really be not just confident in the numbers, but also understand the kind of information that went into it. Because I know a lot of folks, when it comes to carbon emissions or climate, which is what Carbonhound specializes in, is purely the carbon emissions piece. But a lot of people use a lot of estimates to get to scope 1, 2, and 3 emissions reporting. So it's fine to use estimates, but where we see technology really comes in to help the leaders of organizations manage their climate-related risks is really in understanding the level of quality. So what's the metadata behind those emissions numbers? And that's where, with our B Corp customers, we really thrive because they have to be able to have some sort of oversight. And if they wanted to, link executive compensation to these kinds of metrics, folks need to be confident and understand what they're looking at. So really the data is one piece of it, but I think when it comes to governance, technology can really enable in the data quality as well. So you'll notice in the white paper, there's a lot of focus around data quality in this element, because folks can throw together a scope 1, 2, and 3 inventory, but is it good enough is usually the question that we see people ask. And that's where technology can help shed a little bit of light in answering that question for folks.
And actually, just to building on what Erin just mentioned, right? Like it's how you make use of these numbers that you're formulating, right? It's one thing to put out a draft number, but it's really how to extract true value, be it for your organization or for the clients that you're supporting. And if I may just add to what Erin just spoke about, you know, typically we formulate the target operating model across four or five main pillars, starting with the one that Erin just mentioned, which is finance emissions or your net zero processes, the line of business strategy and your underwriting metrics, risk strategy and identification. How does it factor into your risk appetite, as well as what are the committees that are responsible for overseeing these? Do you delegate them down to the line of businesses? Is there certain elements of autonomy, etc.? The stress testing, both on the physical and transition risk front, which we've been doing a lot of work with, and how do you assess and identify the vulnerabilities within your portfolio, depending on the nature of your assets, but also which sectors and subsectors you're exposed to. And lastly, it's that element of reporting, be it for internal purposes and or also external purposes. Underpinning all of that is the one we keep going back to is the governance. You need the appropriate governance framework to help facilitate all of this and make sure that it's adequately implemented on the ground.
Yeah. Amazing. Yeah, I totally agree. And I'm excited that we can get into the strategy and the risk implications of all of this, because I know I'm going to be talking a lot about carbon emissions, and you have a lot of processes that really I think we're going to see are quite intersectional across these four categories. They all relate, which is exactly what, OSFI, and they acknowledge that in B-15, right? All of this is connected to not just B-15 as its own regulation standalone, but it also is impacted by and impacts other regulations that they've put out in all sorts of other areas, whether that's just general risk management processes, and things like that. So I'm excited for the rest of this. Let's jump into the strategy next. And maybe Aly, you can kick it off with some things, some of your thoughts.
Perfect. That's the meaty stuff. So in terms of strategy, obviously, the Canadian economy is quite unique in the sense that a lot of our clients have a massive exposures to, which is the case for Canada, right? Like real estate, for example, agriculture. We speak a lot about infrastructure in general, right? And a lot of our clients have mandates to support these strategic sectors that are really um, important for the Canadian economy as a whole and for our GDP, etc. And they've been also outlined in the federal government's plan in terms of the transition or the greening of the Canadian economy in general. When it comes to strategy, we really like to think of it as you want to understand the transmission channels. And what we mean by that is, are you actually impacted by climate risk, and how does it manifest itself? In the past, unfortunately, and in the early stages of climate risk, it was seen almost as a silo that is separate from the other risk stripes. But what we like to recommend, or what we say to our clients, is it actually transcends across all the risk stripes that you currently have within your inventory. It not only does it impact you from a regulatory or reputational risk, but it also impacts your credit, market, and operational risk as well. So, and from that perspective, it should not be seen as a siloed effort at all. It should be embedded within your core processes across all of these risk stripes. The first step of which, as I mentioned, is assessing how are you impacted by climate risk in general, and how does your business model and your underwriting metrics, etc., need to be adapted to adapt to such a change and to meet the ever-changing change in consumer sentiment and the demands for innovative financing products. And I'll give you one example. One of them is to help your clients support them on their journey for transition, but also it's to basically mitigate the risk of your own vulnerability of your portfolio, right? And we've seen a lot of strides recently in this specific area. More importantly, you also don't want to jump the gun of sorts and end up in a situation where you get accused of greenwashing or misleading your investors as well. There has been a lot of advancements in this specific area. Obviously, the EU as well as other jurisdictions may be a bit further ahead in that curve. Just as one example, right? Going back to the greenwashing example, um, in the London Metal Exchange, right? It was a group of mining companies actually suggested that they go forward with a green nickel futurist contract, but upon an analysis of that instrument, it was deemed that there was no sufficient demand as of yet, and people did not really understand how could they differentiate, or where is the true value proposition of introducing such a financial instrument, and how to differentiate even the processes of green nickel versus normal nickel. So that's an example of going to market maybe bit prematurely. The other element is ESG rating, right? And the one thing we say to our clients is OSFI B-15 sort of pushes for three main themes: traceability, being able to sort of verify where you're coming from and what data you used and how did you get to that strategy; comparability, standardization across the industry, right? Relative to the same industry peers, also that are of the same size as your institution, but also transparency. And that's a key theme over here from OSFI B-15 around the disclosure framework. We're seeing a lot of efforts and collaborative efforts in terms of the data acquisition, but also in coming through with green products, green financing products to help these strategic industries in the Canadian economy. For example, we currently have the GGC, right? Like that's the Green Global Guarantee Company. That's backed by the UK government. And the whole essence of that company is to actually provide guarantees similar to the ones that we know of in the financial industry, specifically curated for the developing countries that may have trouble accessing credit, be it on the green bond issuances or even in the private market. And the list goes on with the World Bank revamping their guarantee program. They've started a new outcome bond that's mainly focusing on pollution and recycling of plastics, et cetera, et cetera. Over to you, Erin.
Yeah, no, I like that you mentioned the international kind of context as well. It's really important to recognize that because, OSFI's B-15 impacts Canadian financial institutions, right? So what we have seen at Carbonhound especially is, yes, we do a lot of work with financial institutions, but we're also tracking scope 1, 2, and 3 emissions, including supply chain emissions for manufacturing, right? Other industries that have similar problems to financial institutions, and they also need that data to dictate their own business strategy, right? We actually did some research recently, just internally, but we were estimating that there are about 56,000 companies that are currently impacted directly by other regulation that includes scope 3 data. So, for example, you already mentioned CSRD. There's also SB 261 in California, other jurisdictions, other exchanges that are requiring public companies to report this, and there's probably more. But what's really interesting is that for the companies in this context, it's financial institutions that need to measure their scope 3. In order to get anything meaningful, there's a level of stakeholder engagement that's required, right? So in the context of manufacturing, we're already collecting data through supply chains for, large producers, food and bev manufacturers, folks with quite complex supply chains. And so present state, to your point, OSFI is saying, okay, we just need to start with estimates, but really we're trying to get to a point where we can track emissions data on a more granular basis. And if you relate it back to PCAF, they're talking about score 1, data quality, right? And what's really interesting from our perspective is that, when you're trying to calculate your climate risk, or if you're trying to calculate the opportunities within your portfolios for, say, green financing, what are the parameters that a customer would have to meet to be included in some sort of green bond issuance, things like that. And so what we're noticing at Carbonhound is that, emissions is one variable that you could use to evaluate the carbon intensity of a loan, right? But what's really interesting, when you actually get actual data on a loan by loan basis, you can also track people's activities year over year. So for example, say you had access to your entire portfolio's direct carbon emissions and the metadata associated with that. So you can say, X% of someone's footprint is estimates versus real data. Now what's interesting is that you've unlocked not just your carbon intensity of your portfolio, but you can also start to do some analysis on what are the behavior changes that folks are making, which could possibly open up strategic business opportunities, just that you can capture as an organization. An interesting metric is that 87% of Carbonhound, our customers, are already calculating their carbon footprints because their customers are asking for it, right? They're selling into Costco supply chain, they're selling into some sort of regulated supply chain. So there's already a business motivation for folks to have this information ready. So by the time, the hope is at least, by the time that banks actually ask their customers, because it's harder to ask your customers than your suppliers, we understand that. But once you get to a point when banks actually need to upgrade to score 1, our hope is that it's actually not that hard of an ask for your customers. Maybe they'll already have that information available in a format that provides both the data but also the metadata in terms of quality. And so we're already doing this in the manufacturing space. And I think it's interesting to bring up because they're very different industries, but there are some similarities in the sense of climate data and how we deal with that and figure out, what do we as a business focus on? And so obviously the role of technology is to enable all of this information sharing because you're dealing with massive data sets. So technology is obviously critical to make that useful, but it's a really interesting use case that we have in an industry that's already quite forward thinking.
Thanks, Erin. And I mean, one theme that seems to come through from what Erin just mentioned is client engagement, right? Like, how do you
Yeah.
engage with your clients to formulating all of these green bond issuances and whatnot requires a comprehensive understanding of your exposures and what sectors you're involved in. As Erin just mentioned, the KPIs that are involved and how you track the performance of these sectors differs drastically from one end to the other. And depending on the nature of your exposures, you need to adapt and be able to formulate what makes most sense, not super complicated or operationally burdensome internally, but also allows you to truly add value to your clients as well.
Hmm.
And
Yeah,
that's where
I
we see
agree. Hmm.
maybe, and that's where we see as well the element of signposts or these heat maps, which we've seen in the Bank of Canada, the pilot stress testing exercise, just to identify those risks and opportunities across the portfolio and where to focus your efforts on, right, Erin?
Mhm. Yeah, yeah, for sure. And I think the kind of what you're speaking about in terms of having geographic and other data sets to use as well, in addition to whatever you gather from customers directly, is really key. What we're doing and where most people are at are score 5 estimates, right? We start with estimates. Everybody does that for your hotspot analysis. This kind of like perfect future that I'm alluding to in this section is very much that, right? Like nobody is doing that at scale by any means, but it's interesting to think about and take inspiration from other industries to see what is possibly technically or possible. And when it comes to actually engaging your customers and figuring out how to operationalize something, obviously technology reduces the burden to a degree, but there's always a human element. I often get questions about the ag sector, for example, and engaging that sector is a huge concern for a lot of FIs, with good reason, right? Because who knows, if you haven't engaged with them in this capacity yet, you don't know what their reactions are going to be. But if there's a way, to your point, to create new products and actually help people maybe in other ways that are outside of the financial sector, then there are quite interesting initiatives that can come from that too, if you have the data available.
And we've seen that evolution through the TCFD disclosures, right? Like you've
Yeah.
seen that clients going from score 5 to score 4 to score 3 throughout the years and improving the data quality, getting more accustomed to what their clients are actually willing to offer versus what not, et cetera. Because there are, data vendors are out there, but there is often that lag or gaps in data. You need to sort of develop in-house proxies to bridge that or mediate for that as well, right?
Yeah, and the reality is there's always going to be some combination of estimates and actuals, right? Like anything.
Absolutely.
So it's just a matter of starting somewhere, and then everyone as an industry hopefully can figure it out together,
Absolutely.
with collaborations like this, which is awesome. Okay, should we move on to risk next?
Fair enough. Yeah.
Let's do it.
So risk is where a combination of things come into play, really. And as we mentioned, it starts off with the identification of the assessment, a materiality assessment. How important or how big of a risk is climate to your organization? Be it from both a physical and or transition risk, depending on the nature of your portfolio and the sectors to which you're exposed and your or geographical location as well. Here at EY, what we've been working on with our clients is both a qualitative as well as a quantitative impact assessment of such risks that has you basically benchmarking all the accredited or industry accepted climate risk scenarios, be it from NGFS, IPCC, IEA, etc., tailoring it to meet our clients' portfolios. And not only tailoring it, but getting them comfortable with understanding the transmission or transition pathways that are embedded in such scenarios. What are the parameters and the assumptions that are embedded? As I'm sure you're all aware, there are a whole sum of assumptions that are embedded into such scenarios, starting with, for example, the adaptation of new technologies, commercialization of carbon capture and sequestration, carbon price hikes, political uncertainty, geopolitical tensions, etc., etc. How do you make sense of these scenarios, and how do you get the right stakeholders around the table and the buy-in from such stakeholders to accept that these are the right scenarios to go by? That's the first starting point. Then comes the element of how do we quantify it? And really, we've seen that just like in typical ICAP processes or stress testing processes, what we like to do is to formulate it into key drivers or key KPIs, be it that impact the bottom line of our customers, basically, be it the balance sheet, cash flow, or income statement. How does that impact your PD? How does that impact your LGD, your bottom line in terms of also capital adequacy ratios? That all is a key risk driver that we then work with our clients into formulating back into the risk appetite. And what is the right oversight over such a risk appetite? Recognizing that this is step one of the process and this will evolve over time. You will not get it 100% right from day one, but you need a starting point. And that target that you set is what we call a moving target. And just as Erin just mentioned, because it doesn't matter the endpoint as long as you're comfortable with the transition pathway. And what are the key milestones that you need to hit across the given the long-term nature of these scenarios, right? Like typically banks are accustomed to 1 in 10 or 1 in 5. Here we're talking about a 30 to 50 year time span. So that's quite different. So we need to start with the short term, get the base right, and build on top of that to make sure that we hit our long-term commitments with respect to climate risk. Over to you.
Yeah. Yeah. No, amazing. And maybe for the folks, just in case we need to define some acronyms. So PD meaning probability of default, and then LGD, loss given default. And I'm going to speak on that as well, because that's where the data really comes in, right? So when we're talking about using data to evaluate those material risks within your portfolio, maybe just to take it a step back, for folks that might not be kind of fully into the context or be aware of the context here, when OSFI is looking at the specific risks associated with your portfolio, they're trying to understand, the typical way of calculating a probability of default or loss given default of a loan have been set out, right? That's been around for years. But what OSFI is trying to achieve with B-15 is to understand how climate will impact those PD and LGD calculations, right? So when we're saying, okay, perhaps you have your loans that are very carbon intensive, perhaps, there are so many different ways that climate could possibly change either favorably or unfavorably your probability of default or loss given default based on how either carbon intensive the asset is, because that can impact future value of assets and the losses remediation costs associated of selling if default happens. But then to Aly, to your point earlier, there's also the transition. And I think in the feedback that OSFI received from the FIs during their consultation over the last little while, they pointed out that folks are quite confused about how to integrate climate considerations into your probability of default and loss given default calculations. And this is very understandable, right? Because we don't have the data. Everybody's using score 5 estimates, which are, not super reliable, definitely not for making any business decisions. However, kind of leaning back into what I mentioned in the strategy section, where you can use your better data and your activity of how people are managing their climate risks by either noticing whether customers have improved the data quality, or they're actually reducing their footprint, or they're starting to measure their footprint. Those can all be proxy indicators for banks to evaluate whether or not a given customer is taking action on climate. And you can decide how you want that to impact the probability of default and loss given default calculations. But once you get past score 5 and you start actually increasing the quality of your data, obviously you can better manage the risk over time. And so when you think about the technology kind of enabler side of things, that's where, again, technology is absolutely critical to be able to assess these types of variables, because you're processing so much data on a loan-by-loan basis to be able to contribute to the PD and LGD calculations. So I think what's really interesting is, there's the whole quant side of it, which obviously Aly and I can nerd out on for a long time, and how these calculations could be impacting each other. But really the main value of using technology beyond just improving those calculations is just even having access to timely data about your carbon, right? We're not even at a point of having any true insight into what portfolios emissions are. So when you have, technology that can actually handle, maybe it's more timely reporting. For example, for Carbonhound, our customers are generating monthly, quarterly, and annual carbon emissions reporting. So being able to not just calculate that on the company level, but then also filter it up to the banks to use in their own calculations, you really just speed up, and you can then, have better risk management processes as a result of that data. So you'll notice in the white paper, the enablement section here is really speaking a lot to kind of using that underlying foundational data to then build those processes on top of, which takes a whole effort on itself. But at least the climate technology side and where Carbonhound comes from is really just giving folks that kind of insight for then, partnerships, whether it's an EY partnership or, the other work associated with it is just much easier, and it's then enabled to improve over time as technology does advance.
Absolutely, absolutely. And it transcends even beyond risk management, right? Getting
Yeah.
these right, be it the climate add-on on top of your normal credit or market risk, not only better enables you to better manage the risks associated with your portfolio, mitigate the vulnerabilities or whatnot, but also facilitates you as a client having the right conversation with your customers, right? The frontline
Exactly.
relationship managers. How can we better support them? Because in general, and just maybe going back to the strategy element a bit, the approach, at least in the beginning, has always been twofold: either divestment or I'm going to reduce my exposure to these sectors. But guess what?
Yeah.
Those comes also with risks as well that maybe financial institutions are not willing or not prepared to accept, right? Now we having these right enablers and the right technology to facilitate all of this introduces a third option, which is how do I facilitate their decarbonization while maintaining my exposures, introducing new
Yes.
technologies, introducing ways to help them transition to a more efficient way for all their processes and enabling them to reduce their footprint while also maintaining my profitability to help support a wider range of our economy as well.
Totally. Yeah, and maybe helpful context could be that I did spend some time in the TD environmental and risk management team, and so I know one of the big things that folks talk about across the industry is exactly what you just mentioned, right? It's not binary. You can't just work with folks or not work with folks, and so having that insight, to your point, I think is really, really critical because that's always been the intention, right? There's a reason why people haven't divested entirely from oil and gas beyond needing energy. But I think it's such an important point where it's like the strategy kind of opportunity lens and the risk identification lens are just two sides of the same coin, really. It's just how you're using that information to, of course, manage your risk, but then also make sure that you're getting the best strategic guidance and you're making the best decisions for your business in an environment where the climate is definitely changing and there are definitely going to be policy changes. It just depends on how orderly that's going to be. Yeah, so we can probably talk about that forever, but let's move on to metrics and targets, Aly, if you're cool with that.
Perfect.
Awesome.
Now, for metrics and targets, going back to Erin's point around finance emissions, right? Data is key, and we cannot overstate its importance, especially depending on the type of asset. If we're talking about project financing, for example, right? Infrastructure is notorious for in agriculture as well, right? Having the right set of data, making sure that you engage with your clients early on and routinely enough to have those conversations, make sure that they are able to support you in that journey, be it for your scope 3 emissions during construction, operation, and or end of life as well, allows you to have that ever so important baseline upon which you can start exploring your options for how do I set my interim targets towards the final commitment for climate risk. Are my targets going to be absolute based or intensity based? Or even now we're starting to see a third option, which is reduction based or avoided emissions based. So it's no longer a question of just absolute versus intensity. It's actually avoided as well versus a baseline scenario where we could have perhaps invested in a oil refinery, for example. What if we invest in a solar plant? How much avoided emissions through that financing have we gone through?
Yeah.
That's one question. The other is going back to the risk management. How do I get comfortable with the transition pathway? How do I continue to evolve that pathway given the dynamic landscape that we currently live in? And responding to that question has always been very similar to the current industry best practice, which is to review these risk appetite metrics and your stress testing exercises on an annual basis. It becomes ever so important to do that and build that culture On the climate risk front as well, if not annually, we also think it should be even done more frequently on a semi-annual basis, given just how preliminary and the vast amount of changes that we're going through as the industry on it as a whole matures. To facilitate all of this, and maybe on the screen as well, we have it up, is the ESG data architecture. There is a lot of vendors out there, publicly available databases. You need to understand which one works best for you. What are the embedded assumptions and lags and data gaps that currently exist? But how can you blend them with internal data acquisition channels that you have with your clients? Develop, as we mentioned, appropriate data proxies and continue to evolve those as you seek to improve on your data score for something like the carbon footprint through a PCAF methodology. Erin?
Yeah. Yeah, and I think from a carbon emissions perspective as well, that data lake that you're referring to, there are lots of different ways that folks could calculate their financed emissions. And I know PCAF is obviously the standard that everybody's using. And it's important to keep in mind as well that OSFI does not require folks to use PCAF data. I know it's quite expensive. And we've had some conversations with smaller FIs where, they're not sure whether or not that's the route for them. But what's really important here, and you've alluded to it already, Aly, is just that folks at OSFI are looking for transparency, right? They just want to know how you calculated your scope 1, 2, and 3 emissions. And when it comes to finance emissions specifically, they want to be able to have a level of, of course, the aggregated data, but they want to have a level of depth as well, so then they can understand where exactly your risks lie. And something that is quite important to think about, especially as OSFI has required or requested that folks also focus on improving the quality of that data. So, starting with estimates is expected. There have also been some questions around how much time do people have, to upgrade from score 5 to score 1 data quality, and none of that has been explicitly defined. I think that's really important to acknowledge in the context of OSFI's regulation, is that, again, it's a situation where everybody's trying to figure this out together. And when it comes to score 5, we're working with financial institutions to very quickly get a score 5 finance emissions estimate done. It's not overly complicated. We have models that we use that we've, worked with a number of stakeholders to develop. But again, what's really interesting is the fact that, this is the starting point to get to a place where we can confidently consider climate in that, probability of default, loss given default metric, and then have it embedded throughout your organization. And I think people often get hung up on, okay, what do I need right now? Which is completely valid, right? You need to put your disclosures together for the next couple of years. But it's really useful, I think, to also kind of stay grounded in what's the ultimate goal here. And do you have the systems in place to get to a score 1 data quality future? And if the answer is no, that will be fine for a couple of years. But I think it is really important and critical for everybody to be thinking about where they're kind of setting themselves up for, and where the industry is going. But I do want to validate that a lot of folks we work with are starting with score 5, maybe score 4, maybe score 3. And just to say, starting somewhere is what's important, and you can always work your way towards as things evolve as well.
And that brings us back to the whole idea of the target state definition. What is it that as an organization I'm aspiring to? You need to start somewhere, but you also need to make sure that even if your goal is to be minimally compliant with the regulations and expectations, you run the risk of sitting behind the curve with respect to your peers or whatnot. So, and that's where the definition of that target state comes in handy to set the expectations across the enterprise, be it from a strategy, risk management, as well as a disclosure perspective. And which areas do you want to focus on to be pioneering and really bring an edge to market as well?
Yeah, totally. And I think that's a good point, again, of just why partnerships, like there's the software element, but then there's also the advice element to all of this. And, we're working with a lot of smaller FIs, and, and credit unions who are very budget conscious, right? So, they love to use software because we can help upskill their teams and get to a point of where they can be self-sufficient. Like, that really is the goal here, is to make sure that everybody is upskilling and able to operate in this new future that we're coming up against. But there's always going to be some level of confidence. And what are those roadmaps look like? What is industry doing when it comes to building these processes? And I think we already have some questions coming through that we can address at the end. We do have some time for Q&A. But I think everything we've kind of covered here really just reemphasizes the importance of having these kind of software in addition to services, which is the reality for most people. You'll need some hybrid of the two to get to disclosure that you feel comfortable enough to submit, especially to regulators. And then, when it eventually is becoming public disclosure, even more so. But we can start somewhere for sure.
Absolutely.
Awesome. Okay, so I think we have a little bit of time left, and it might be worth bringing Katerina back in to kind of speak to some of these questions. Okay, there she is. And maybe we can we'll maybe hide our PDF as well, just so folks know. This white paper is available on, I think we all shared it on LinkedIn, but we'll also be sharing it to anyone who's registered to the event specifically. If you have the registration and you filled out the form to join, we'll be emailing it out to everybody as well. So don't feel like you need to, take your screenshots and all that panic as we're going through these questions. You might bring it up. Okay, so I think we have a question here, and anyone can kind of take this, but the question is from Stuart. So how do we actually calculate the probability of extreme weather events and loss given defaults? How do you calculate transition risk? I don't know, Katerina or Aly, if you guys want to take that.
Yes, we can go ahead, and that will require longer time, and we can even
this is a whole hour
another webinar on that topic. I'll go first, and then Aly, feel free to add anything that I'll miss. But what I will start is that, of course, in Canada, we lag behind, right? So there is a lot of work that was done in the last 3 years in Europe and in Asia. And at this stage, we know very well how to model transition risk and physical risk, saying that, the methodologies, the regulations are, still evolving, and the data availability, as Erin has already mentioned is quite fragmented, right? So we'll still see a lot of evolvements, but at least now we know how to model both transition and physical. So I will start first with transition, and then I'll go to physical and invite Aly to add anything that I'll miss. When it comes to transition risk, first of all, for everyone awareness, what we're trying to do is to understand how changes in policies will affect the potentially the financial performance of obligors within a lending portfolio, right? So the transition, if it happens very quickly or very aggressively, it might leave unprepared sectors and unprepared clients or companies behind, and as a result they might not get access to funding, and that might come with secondary credit risk implications, right? So what we're trying to model when it comes to transition risk is first how a climate scenario affects some key drivers for a sector. So we tend to look at it when we think about transition, we tend to think about it in terms of sectors, right? How the transition will affect agriculture, how the transition will affect the real estate market, how the transition will affect the oil and gas sector. And we need to understand for the, while we'll model that, we need to understand some key drivers, such as how the volume will change over the forecasting horizon, how the price, the capex, for that sector will be affected. And once we model that, then the next phase of modeling is around how the financial performance of counterparts of companies that operate in this sector is going to be affected as a result, right? This is important because you need to think about it that it's one factor is what is the company's financial health at the beginning of the forecasting horizon, and then depending on the sector that they operate, they might be affected more severely than others, right? So you need to take both into consideration. And then eventually, what you do there is really financial modeling, right? So you're trying to, understand some key, financial metrics and how balance sheet, income, cash flow statements will be affected. And then eventually, fit that information within your already existing probability of default, models. So that's the one way to do it, which is the one that is a bit more sophisticated, and it allows you, and like Erin, you mentioned already, the difference between approaches or methodologies that can help you to drive decision making versus the ones that are, a tick box exercise, right? The approach that I mentioned is granular enough to enable you to leverage the output of this exercise, not only to be in compliance with regulatory requirements, but also to inform that information to drive, to inform your decarbonization strategy, or inform your portfolio management, strategies, or even your client engagement strategy. Where do we see that some clients or sectors will be more severely impacted, and how do we make sure that we engage with them early on so that we can avoid what it might come in the next 10 years because of the transition. So that's one. Another approach is what we call, and this is the bottom-up approach. Another approach for transition risk is the top-down, which is usually recommended for the ones that are in the beginning of their journey, or the ones that but they might not necessarily have the capacity internally to model, at the bottom-up level. So when we talk about top-down for transition risk, we focus more on macroeconomic variables rather than climate variables. But those macroeconomic variables are stressed by a climate event. So as a result, you're able to experience that climate severity. But then you go through your already existing IFRS 9 process, in the sense that you leverage macroeconomic variables that are stressed by a climate event. You stress your transition matrices, and then eventually you're able to get your probability of default and loss given default. So this is on the transition. Now on the physical risk side, what we're trying to do is, if the policies that we apply are not effective enough, or if there are no policies, then the temperature will continue to rise. And that will result, based on science, in more frequent and potentially more severe physical events. So what we're trying to do there is to understand, and we split, when it comes to physical risk modeling, we need to think about it in terms of acute events like flood, wildfire, and in terms of chronic events, sea rising level, for example, or heat. Heat can be classified actually in both. You can have heat as an acute and heat as a chronic. And then you're trying to understand in the acute, what will be the damage. And usually we focus on real estate portfolios, and this is where the collateral and the LGD components come into place. And then when it comes to chronic, you might want to focus a bit more on the productivity of the sector, the operational losses, and all that. So, and again, it's very complex to be discussed quickly, but at a high level, that's the approach that is followed. Aly, anything you want to add in both transition and physical risk?
I think you covered it extremely well.
Thanks.
Just to reiterate, underpinning all of this is a massive amount of data. Like, this cannot be understated. Just using the transition risk as an example combines the publicly available sources from these scenarios, which is a whole ton of parameters that you need to be comfortable with, combining it with operational and financial data relevant to your counterparties, if we're talking about the bottoms up approach. That's just for the baseline, and that really feeds into your methodology to allow you to forecast that from a financial modeling perspective, as Katrina mentioned, over the scenario's lifetime. But I just wanted to reiterate that there is a massive volume of data that facilitates all of this, and that's quite unique to the ESG data architecture concept that we were talking about, but because it combines not just one data acquisition channel, but multiple, both public and private, internally available versus externally.
Oh, we lost Ali.
I think
But
we
I
lost
think he
that.
raised a really good point, and maybe what I will add before we go to the next question is that what we seem. Oh, hey Ali, I was just continuing to what you were saying, in the sense that, exactly as you said, and that's why what we see in the market is that the teams are not working in silo, in the sense that the modeling team within a financial institution that is responsible for building the models for transition and physical risk is working actually very closely with the data and IT teams, because we want to ensure that there is such a big effort when it comes to gathering the data, defining the data dictionaries, ensuring that the data is stored at a place where various different, consumers within the organization will be able to get access to it. So usually we tend to see that, modeling projects to run alongside ESG data utility or data strategy and technology projects. Yeah.
Amazing. Thank you so much. And Aly, you're back, which is awesome. I think we have time for maybe one other question, maybe two. So the next one here is, do your models account for potential policy changes? I think we might have spoken to that a little bit in the last one, but is there anything else you guys want to add there?
What I can add, and maybe Aly, you go ahead as well, but when it comes to transition risk, this is exactly where we want to capture the potential policy changes. It's embedded within the scenario, right? The scenarios that we're leveraging, and that's why usually you tend to see financial institutions leveraging more than one scenario. And actually our regulator is proposing, or they will release as part of the standardized climate stress testing exercise, 4 scenarios. So, and those scenarios usually account for an orderly transition, which means that we take action early, the policies are effective, and they allow us to meet our net zero goals in an orderly fashion. And this orderly scenario is a scenario where we take action, but we take action late. And as a result, those policies need to be more aggressive to allow us to reach our net zero goals. And then a no action scenario where we don't make any policies, and as a result, the temperature continues to rise. And when we run our stress testing models, and Aly can share even more about that, it's very clear that the cumulative losses that financial institutions will face increases significantly as you go from the orderly to disorderly and no action. It's very clear.
And these policy changes are quantified or modeled through the parameters embedded into the scenarios. For example, the NGFS, which is a general equilibrium model, already has that, and you can see it through, for example, something like the carbon price, or the fact that, for example, such as the federal government, internal combustion engines, after a certain point, you will no longer be able to sell internal combustion engines. By default, that means that, for example, in a certain point throughout the scenario, you shall see an energy spike, for example, for EVs as mandated by the federal government. So because the general equilibrium model combines the macroeconomic variables with the energy demand, these policy changes, as Katerina mentioned, have already been quantified in the parameters that our model then utilizes.
Yeah, amazing. Awesome. And I think at this point, it might be good to remind folks as well, like everything that we're talking about here, we can go from very low fidelity modeling for use in smaller organizations to just meet the need that they're seeing, all the way up to these incredibly complex models. And I think, we've already kind of mentioned that in a couple of times, but just since we're getting a little bit more into the weeds, I wanted to reiterate that everything's right sized based on the needs of the specific organization, right?
Very good point, Erin, and maybe I will add to that just to share some market perspective with everyone that is, attending this webinar today, that even like the large financial institutions, and that applies, I believe, to all the financial institutions, it's not that they're looking to go to the high levels of sophistication when it comes to these models from day one, right? Because that comes also back to, Aly's point, with lots of complexities outside the modeling, right? Components is data, is operational readiness, is, access to resources with the right skills, right? So taking all that into consideration, what we see in the market is more like a journey, right, over the next 3 years, where we will see financial institutions, no matter their size, wanting to achieve minimum compliance first, and then add sophistication strategically and where is needed, so that decisions can be made and so that you have a better understanding of the risk that you are taking, as well as the opportunities that might lie ahead, right? But this is definitely a journey that everyone starts with. It's almost like baby steps, so we are able to manage all the risks that come and they're outside of the actual modeling exercise.
Yeah, amazing. Okay, I think there's one last question that's just asking about timelines, which we might speak to really briefly, because I think that is important. We get those questions a lot at Carbonhound too. I'm sure you guys do as well. So the last question here is, can you talk about the reporting timelines? How long does all of this take? we have maybe 2 minutes left, but maybe high-level thoughts for your guys' side on kind of the broader project holistically, and I'm happy to speak to the carbon emissions side from for Carbonhound's perspective.
Katrina?
Yes, I can go with the timeline. So, sorry, I thought Ali, you might want to take that one. But as I mentioned, and I believe we mentioned it already, right? That OSFI is taking into consideration that depending on the size of the institutions, there might be differences in how in the level of readiness, right, in the level of maturity. So what OSFI is proposing is that first, the large financial institutions, including banks and insurance, will go first. The disclosures requirements start from October 2024, and there is a period of 180 days, after that, for large financial institutions to disclose the information that is needed under B-15. And then the smaller financial institutions will follow next year. So for the majority of the people that are attending this call, I believe it's the October 2025, deadline that it will apply. And also some information for you so that Scope 3 emissions is expected 1 year later. And also when it comes to transition plans, we are still waiting for OSFI to define the dates for transition plans.
Yeah. They're still TBD, and maybe on the emissions side of things as well. I think a lot of people see that year delay for Scope 3 as kind of time to get things together, which it definitely is, and it's not well used if it's a procrastination year, because we're seeing that at least on the data side, right? Like getting Scope 1, 2, and 3 inventories together, even with technology like Carbonhound. We can do it in a matter of weeks, not really months when we're talking about an operational footprint, Scope 1, 2, and 3, right? So everything except category 15, which is the investments. But once you layer on the finance emissions element, which is Scope 3 and it's part of B-15, that is what does take time. Even if you're using estimates, there's a lot of time spent in gathering the right data at the right level of granularity needed to be able to issue this reporting. So if this is something that's on your radar, definitely, you can reach out to anyone to ask questions on this call, right? We do this all the time. But from the data perspective, that's a whole line of work in addition to all of these processes and the disclosure preparation and things like that. So something to keep in mind, the delays are great, but also it's there for a reason. So make the most of that.
If I may add,
sorry, Ali, maybe it's important to know that for financial institutions, Scope 3 category 15 is the most material category in terms of emissions, so it needs to be prioritized. Exactly as Erin mentioned, in all of the engagements that we are running, and Ali can share more, both from a consulting and from an assurance point of view, that most of the time is spent on the data collection process. And then aligning the sector classification codes and all of that. And then on top of that, based on the report that was released from OSFI on the maturity of the market when it comes to Scope 1, Scope 2, Scope 3, it's very clear that financial institutions are way more prepared for Scope 1 and 2, but there is still a lot of work that needs to be done on the Scope 3, and it's an area where we expect many of you to be focusing in the next year. So, Ali, sorry, I cut you there.
No, I was just going to also emphasize that there is an element of socializing the results internally as well that takes time.
Yes,
getting people comfortable with these figures, be it from an absolute or an emission intensity. Does it make sense to the first line of defense, the people actually conducting the deals, getting them comfortable with this is our baseline of choice as well. We've seen that, conversation of what is the appropriate year of baseline to use for our target setting also. So that's another component that you might want to consider as you plan for that exercise leading up to your external disclosure or TCFD report as well.
Yeah, amazing. Okay, I think we have 2 minutes until 2 p.m. Eastern, so let's wrap it there. Thank you so much for joining me today, guys. It's been great chatting. Are there any last thoughts before we close things out?
Ali, feel free to go first.
No, I mean, feel free to reach out to us. We're happy to support. Everyone needs to start somewhere, and there is an element of a learning curve over here for everyone, and we do recognize that. What we usually like to say to our clients, it is not a one size fits all. So we will work with you on tailoring something that works for you, for your organization, and to make sure that you really extract value from all of this, not just have it being another report that you sort of push out the door as well.
Yeah.
Exactly. Couldn't agree more, Ali. And maybe if I share some thoughts, exactly as Ali mentioned, thank you very much for joining us today. I hope you found this session useful. And we are here to support in any way, in the sense that one of the things that I'm keep hearing from all of my clients is that we don't know what we don't know, right? Since we serve the market, we have a really good understanding of some of the struggles that, your peers are facing, and lessons learned that might help and accelerate your journey, right? So we're happy and we're here to help, and through partnerships like the one we have with Carbonhound, we aim to accelerate your journey and make it easier in ways and add value where it's absolutely needed.
Amazing. Great. Well, thank you so much, you both. Great session as always. And we'll send out a follow-up to those who registered and post all the links in the comments here as well for folks to look at the white paper and reach out if they have any other questions. I hope you have a great afternoon.
Thank you.
Bye, everyone.
Thanks.
Thank you.
Bye. Bye-bye.